So I think looking at the FX markets and looking in particular to what happened to the yen overnight, clearly the market is pricing in near-term de-escalation based on what happened over the weekend. And that's why the yen is making a fresh 34-year low. So I think that's the main takeaway from the FX markets. But I would also add, even though we're pricing in near-term de-escalation, the longer-term geopolitical risk premium probably has to go up. The fact that we moved from a proxy confrontation to a direct confrontation, even though that de-escalates in the near term, the longer-term risk premium probably goes up. But I think the FX market ultimately will take its cue from oil prices, because ultimately that's the channel through which it spills over to the FX market.
Yeah, and very often an inverse relationship in the oil price and the dollar. Safe havens, obviously, the Swissy as well. Where does the dollar fit in that safe haven trade? Again, as I say, very often an inverse relationship between the dollar and the oil price. Yeah.
So I think it's changed a little bit, not just the relationship between the dollar and the oil price, but also the safe haven properties of the dollar. Keep in mind, especially when I look at currencies in Asia, the dollar is a high-yielding currency. People, when they talk about the carry trade in FX, they actually long the US dollar, not short the US dollar. So when you have risk off, there's always a chance that the dollar actually weakens rather than strengthens. So it really depends on which currency you're looking at, but I do think the safe haven properties of the US dollar are quite different to what they were 5 to 10 years ago.
That's really interesting. Look, I just mentioned you have been on your travels. You've managed to stop over and see us amidst all that chaotic travel. You're normally based in Hong Kong. What have you learned from your travels?
So I was in the US last week, so a bit jet lagged, but I think the main takeaway, obviously, it was the week where we had the CPI surprise. I think a lot of banks, including ourselves, have shifted our Fed rates call. We're now calling for the first rate cut in December. And obviously, that's an environment where US rates and the US dollar stay stronger for longer.
So, Adarsh, I mean, if we talk, as we're seeing things, right, with faster than expected US inflation, as you've just been pointing towards as well, dampening bets of those rate cuts, do you suggest that the battle against the dollar, particularly for the Asian markets then, I mean, does that end anytime soon for them?
Super important question, because as you know, every central bank, and the most important ones, China and Japan, are intervening to prevent currency, or the threat of intervention to prevent currency weakness. The problem is that when the US dollar is strengthening because of US specific reasons, like the CPI inflation data, what are central banks in Asia going to do? At best, they can smooth the move, but they can't stop the move. And I think that's really where the problem is. Now, for dollar yen, they probably have to intervene at some point, but I think most people agree the intervention will probably not be that effective.
So does that mean broader currency devaluation across Asia is pretty much possible, or more, maybe a greater risk even now of continuing?
Yeah, I mean, we have to differentiate between some countries. I think some currencies will do better than others, but I think the two major currencies, which is the RMB and the Japanese yen, probably remain weak. And the biggest problem for them is yield. Interest rates are a lot lower in Japan and China compared to the US. And in some ways, central banks, by reducing volatility, are actually incentivizing investors to buy the US dollar, because the volatility adjusted carry looks a lot more attractive.
We talked briefly off air about lines in the sand on the dollar-yen pair as well. I remember very specifically a lot of analysts and experts in your area saying to me, 120, 125, that is a big line in the sand. We're at 155, give or take the change. Is there a line in the sand? Is there any level at which the Bank of Japan will get serious about tightening or being more aggressive? I mean, again, outright intervention, it's a tough case to make.
Yeah. And it's remarkable. We've been talking about the 152 to 155 range when they could intervene. Now we're close to 154. I think they kind of have to intervene just to retain some credibility, because they did escalate their rhetoric meaningfully a couple of weeks back. And if they don't intervene, if we get a 155 and they don't intervene, then the market is going to run away with it. So I do think they'll intervene, but I don't think we're at the levels yet where it leads to a series of rate hikes, for instance. Ultimately, we know the weakness in the yen is about the rate differential, and it's only a series of rate hikes that might change that, but I don't think the conditions are in place for that yet.
And you mentioned, of course, the other major currency in Asia as well, the renminbi as well. People, again, are looking for more stimulus for the Chinese economy. That, again, is going to potentially raise the debt levels of China. It's going to also raise the same questions about the longer-term prospects for China as well. Difficult, again, to rally the Chinese currency with that as a backdrop.
Yeah, look, I think under most scenarios, actually even in a more sort of optimistic cyclical scenario for 2024, the currency probably weakens. China needs accommodative monetary conditions, which includes a weaker currency. I think most people agree if they hadn't been intervening as heavily as they have, dollar CNY would probably be closer to 7.4, 7.5. Obviously, there's always this concern around capital flight in China, which is why they keep the currency stable. But if the dollar remains strong, ultimately, we do think they will allow the daily fixings to move higher, and they'll allow the currency to weaken.